Hello. In this video, we're going to discuss moving averages, specifically the three primary types of moving averages. The three moving averages, or the most first, let's start with the most common. That would be what's often referred to as an SMA, or a simple moving average. And that is simply defined as if it's a 20 period moving average, you take the 20 last candles, and candles are essentially whatever's ever on your chart. If your chart is a weekly chart, then it's the last 20 weeks. It's monthly, it's the last 20 months. If it's 20 months, if it's daily, 20 days, and so forth. And even if it's an intraday, if it's a minute chart, a 20 SMA is essentially looking at the close of the last 21 minute bars and taking an average of that. And then one quick note, moving averages also can be based on opens, highs, lows, closes. Closes is generally what traders will use. So simple moving average is the most common, but there's two others. Next, I guess in order would be an exponential moving average, and if you can figure out the nomenclature, it would be an EMA. And then lastly, far more obscure, not used by a whole lot of traders, would be a DMA, D standing for displaced. So let's take a look at this chart. It happens to be a chart of Apple, not that that necessarily matters, but I still like to at least tell people what they're looking at. All these three lines are all a 20 period moving average. The green line is your simple moving average. Your orange is your exponential moving average, and then your purple is your displaced moving average. The displaced moving average can be a little bit hard to kind of wrap your brain around. Essentially, the easiest way to think of this is whatever this pair. So what a displaced moving average is, let me rephrase that. And so this happens to be a 20 period DMA. So it's still looking back 20 bars. But what's happening is it's starting here and it's going to go back 20 bars. But then there's what's called an offset. So whatever that value happens to be, it's going to offset it. In this case, it happens to be -4. So if I look at the simple moving average, which is a 20 period moving average, the DMA that I have on the chart before you is the same, but I have a displacement of -4. So essentially that point is going to go back 4 bars. Or if I took this point, that's going to go back 4 bars, and then I'm going to print that point there. So essentially this purple line is just this green line in the example what I have before you, displaced or shifted back. You can shift it forward. So it's just a matter of what you're trying to study. So again, it's a little bit more of an obscure, but I do want to bring that to your attention because it is a tool that's out there for traders. And then there's the exponential moving average. And again, this is a 20 period. Exponential, unlike the simple, is simple, all the periods are equally weighted. Exponential, there's more weight put towards the most recent candles and less weight towards the latter candles. And what you'll see with this, if you look at these two curves, see there's a little bit more twists and turns in here. This 20 SMA is a little bit more smooth. Let's see if we can give you kind of a good example. So again, our SMA is green, and then this is our orange is our EMA. And notice how when price pops right here, notice how the EMA started to accelerate a bit quicker. And that's essentially just because these candles are having a higher weight in the calculation, especially this candle, which is a big one, having a higher weight. Therefore, it's not a true average. It's just a more emphasis placed on these most recent candles. So those are your primary moving averages. I definitely suggest playing around with them. I think you'll probably find the SMA is the most practical for most traders, but there are applications where you will use the others. So with that, appreciate your time. Happy trading, and thanks for listening.